Good evening, everyone, and thank you for joining us. Welcome to Ironwood Wealth Management's Market Insight webinar for Q3 2018. My name is Jared Hurdy, and I am a Portfolio Administrator in Ironwood's Asset Management Division. Tonight it is my pleasure to introduce our featured presenter, the Chief Investment Officer here at Ironwood, Mr. Sean Rogers. Sean is a charter holder of the Financial Analyst designation, and he also serves as Ironwood's primary investment strategist. If anyone has questions for Sean during the presentation, please feel free to type them into the chat box on the GoToWebinar panel on your screen. I'll compile the questions and we will do our best to address them at the end. Now, without any further delay, please join me in welcoming Sean to lead this evening's presentation. Sean, the floor is yours.
Thanks, Jared. Thanks, everyone, for joining the call tonight. Once again, we come into the call with a little bit of volatility. Seems like every time we do this call, we come into it with a pretty significant drop. And I went back and I looked at the last 5 webinars, and including today, and November, February, May, and today, we started the webinar really off of a pretty significant drop in the equity markets. And ironically enough, the S&P 500 at 4 of the 5 times that we've had this call, the last 5 times, the S&P has been right around 2,600. Today it's at 2,705, but before today it was 50 points less. So there's some good things about that, and there's some bad things about that. So we'll go into them more in detail throughout the call. But I was going to poll everybody and see if we should maybe cancel this call for a couple of quarters and see if we can't get a little better luck here. I'm obviously kidding, but I just thought it was kind of funny. Kind of ironic, maybe not funny. All right, so this is actually Ironwood's 10-year anniversary of doing this call. So I added a slide that we had in one of the very first calls that we did, just to kind of put things into perspective a little bit. But this was in our first quarter 2009 guide to the market, or Ironwood Market Insight calls, and you can see that at that time we were in a lot different environment. We had just had a 42% drop going into the end of 2008, and we actually ended up dropping another 13 or so percent at the beginning of 2009 before coming back. But I just wanted to kind of put things into perspective, kind of where we were 10 years ago, so that when we go over the return since October 1st, we don't feel as bad. And I also wanted to get go back 10 years, 40 quarters ago, 40 calls ago, and kind of see where we were. I thought it would be a little fun to look at. So we were at 903 at the end of 2008 on the S&P 500. Since then, we're now at just over 2,700, like I said. So we have come a long way. Forward PE multiples at that time were 12.4. I'll bet if we could all go back to that time, we try and be a little bit more aggressive with maybe our savings and the assets that we had tied to equities at that time. But when you're coming into a stock market that's lost 40-50%, it's very hard to be with any conviction to buy equities with much conviction. But anyway, it puts things into perspective. So let's jump into where we are now. Let's kind of fast forward 10 years. So this year was humming along. Really a tale of 2 stories. You had domestic stocks and you had international, everything outside the U.S. And I'm going to get into that a little bit. But during the preparation of this webinar, a few things have happened, and so I just kind of wanted to take a step back because a lot of the data that I have that I'm going to share with you guys today is through September 30th. So a lot's changed since September 30th. So I wanted to start with kind of where we sit from October 1st. So since October 1st, the S&P 500 is down 9%. The Nasdaq's down 12. Emerging markets are down 11. Developed international are down 11. Small cap is down 14. Global bonds holding up about down 1%. I don't have it on here, but commodities is actually flat. So, you know, that's a little bright spot in the portfolio. It hasn't been for the past couple of years, but during this last downward trend, it's been nice to own 4 to 6% in commodities, like all of our portfolios do. But that's kind of where we're at in the last 20 trading sessions, last 19 trading sessions since October 1st. Yesterday was a pretty significant down day. Today was a pretty significant up day. You know, did we put in the bottom yesterday? I don't know. 2580 on the S&P 500 is that downward level that if we went much past that, I'd start getting a little more concerned. It's kind of the resistance level that we've hit a couple of times and then jumped right off of that. And at 2705, today's recovery looked fairly promising, but we'll see if this is just a head fake or if we continue on the downward trend. It's very difficult to tell, obviously, but instead of trying to predict where the stock market's going to be on short periods of time, what we want to do is we want to pay attention more to the fundamentals and let the fundamentals dictate our decisions. So this is nothing new. We've seen these types of pullbacks since the Great Recession. We've had 9 of these pullbacks that have been over 5.8% during this past bull market. We had the flash crash in 2010. We had the U.S. downgrade and the European debt stress. We had the Eurozone go through a double dip recession. We had the taper tantrum, global slowdown fears. 2014 and 2015 were pretty much consolidation years, so we didn't see much movement with any equity, any aggressive type assets. Kind of a period. I'll go into this a little bit more when we get to some of the other charts, but that's kind of where we're at now too as well. Global slowdown, China, Fed uncertainty. So you can see this has happened 9 times since the Great Recession. And every single one of those times proved to be a buying opportunity. And we've continued the bull market. So we're not going to pretend to know what's going to happen with this next or with this current downturn. But we do know that historically, when markets have pulled back more than 10% from previous highs, it's generally a pretty good buying opportunity. The last 9 times, it's been a pretty good buying opportunity. So we look at it more opportunistically than fear-driven. There's a lot of noise out there. China, interest rates, midterm elections, but once again, it really is just noise. And what's more important is that we look at the fundamentals of the economy, the global economy, and try and make our long-term investment decisions based on those. So we're going to go through some topics here that I've got listed. This is the first time in a while that we actually have seen the global expansion sputter a little bit. Now, when I say that, we're still manufacturing PMIs are still above 50, which still means we're in an expansionary period. But you can see here, if I look at April, May, and June, we were in the 53s on manufacturing PMI numbers. And in July, August, and September, we were in the 52s. And you can see that the trajectory, the trend is we've gone from 52.7 in July to 52.6 in August to 52.2 in September. Now, that is the global trend. Notwithstanding that trend is the U.S. The U.S. has been bucking that trend, and in fact, the U.S. has been improving on the PMI numbers, and that's why you've seen a divergence between the return of domestic stocks versus the return of anything outside of the United States, really. And so this has been reflected in 2018 returns. This slide just shows what the difference in a year makes. 2017, anything outside the United States, for the most part, did really well. Emerging markets up 38% almost. The all country world index minus the US up 28%. The US up 22%. Okay, so international did better than the US in 2017. Fast forward year to date through September 30th, so not including the corrections in October that we just seen, you can see that the U.S. has significantly outperformed outside the United States. S&P 500 up 10.6%. All country world index minus the U.S. -3 almost. So that's a big difference there. Emerging markets down 7. Everything that international gained in 2017, it basically gave up in 2018. Another thing I want to point out on this slide is that you can see in 2018, even before October happened, you can see multiples have been contracting, meaning a big chunk of this negative return that we're seeing from, there's been a big headwind. And that headwind is that investors are no longer paying 19 times for the S&P 500. They're no longer paying 15 times for international stocks. They're no longer paying 14 times, 13 times for emerging market stocks. We've had multiple compressions, which is perfectly normal when you have an interest rate increasing environment. When interest rates are increasing, you're going to see some multiple contraction. It doesn't mean that going forward stocks can't make money. It just means all else being equal, where earlier in the year people were willing to buy the S&P earnings at 19 times earnings, now they're only willing to pay about 15 times. Okay. So let's talk a little bit more about the U.S. economy and kind of the pace that we're at. So like I said, we've seen interest rates increase, and really they jumped at the beginning of October, and that's kind of what set off some of this multiple contraction that we've seen, because earnings estimates haven't gone down. It's literally been, people are just selling because interest rates go up, so they're repricing stocks, and everything's getting hammered. Then people are worried about China. People are worried about midterm elections. You get all of these things at once. We're at all-time highs on the S&P. People want to take profits. This is a textbook technical correction in our opinion. So like I said, ISM manufacturing numbers in the U.S. have been very strong. ISM non-manufacturing numbers, we actually had the highest in September. We had 61.6 in September. That's the highest reading we've seen on the ISM non-manufacturing index in the last decade. So that's the service sector. That's the United States' biggest sector. So that's a very positive sign in our minds when you're looking at how the United States is doing. The job market slowed a tiny bit. We were averaging about 200,000 jobs a month. We dropped to 190,000. Nothing to be concerned about there, especially with the error in each of those reports. The unemployment rate dropped to 3.7%. Wages are starting to increase. The labor market definitely is tightening. We don't expect a lot of benefit from the unemployment rate, the job market getting much better than where it's at. It's pretty good right now. Yeah, it could get slightly better, but we're not going to see big gains in the job market from these levels. We're just there. It's a very tight job market. GDP has ticked up significantly here in the last couple of quarters. Q2 came in at 4.2%, from Q1 at 2.2%. And if we look at year over year in Q2, year over year GDP growth almost hit 3%, 2.9%. The third quarter, we'll get the first estimate tomorrow. That'll actually probably be some pretty substantial news that the market will digest tomorrow. The numbers that we're looking at from analysts are right around 4%, give or take. If we're at 4% in the third quarter, we could see 2018 be 3+% GDP growth when it's all said and done. So, like I said, the U.S. is definitely trending in the right direction. This is just another slide that we've looked at in the past. This has been a long expansion, but as far as real growth, we just haven't had as much as in previous expansions, and you can tell that by the cumulative GDP growth. We're just now getting to some of these lower level expansions, but you can see here at the very end, and if we continue to have 4-ish+ percentage growth quarter on quarter GDP growth, you can start to see the slope is starting to steepen. So that's the correct trend there. We're not so concerned with the length of the expansion because the Fed, in our opinion, isn't really moving all that fast. And when you look at how deep the recession was, we could argue that a deep recession would call for a longer expansion as well. And then when we look at it in context of the stock market, we kind of get a little bit different story there. So we are up since, and that first slide that I showed you, it was a time frame from like right here all the way to here. So we only saw these two dips here, and there's a lot of folks who are just waiting for the next dip. And so I want to just spend a little bit of time talking about this. Just because we had 50% declines on the S&P 500 the last two recessions, and that's what everybody remembers. 9 of the last 11 recessions, so except for these two, the last two that we've gone through, the previous 9, we only saw 25% drawdowns, not 50% drawdowns. So if we have a recession, it doesn't necessarily mean that we're going to see 50% of the S&P gone. Those are abnormal type recessions. So if we do get a recession, we don't see one anytime soon. But if we do, we would be in the camp that believes it would probably be more like a 25-30% type of recession, pullback in equity prices versus 50% drawdown. So now let's take a look at, so we're up 331% since March 9th, 2009. And many of you might say, well, that's a lot. That's a big return there. That's a big price movement. That's a pretty good expansion. It is. It's the fifth highest price return from the previous bottom. So just to kind of put it into perspective, in 1975, we had an expansion, a bull market that returned 375%. We had a bull market in 1921 that returned 385%. We had a bull market in 1949 that returned 413%. And finally, we had a bull market in 1988 that started in 1988 that we saw 514% increase in the S&P 500. So even though lengthwise this expansion it is a long expansion, price-wise over the last 9 bull markets, or last 10 bull markets, we're right in the middle. We're fifth. So it doesn't necessarily, and after the most recent pullback, this number is down quite a bit, because 10% on 2914 is a lot less than 10% on 677. So we're probably say 300% up instead of 331. So we still have room. Don't look at this and say that we're ready for a pullback just because we've gone up 331%. There have been times when we've made a lot more money than that. What we do see, and in history we've seen this, is where bear markets can last 20 years and you don't really go anywhere, up, down, and then you've got these bull markets that last about 20 years, that you've got a couple of periods where you go up and then you consolidate, and then you go up. And in 2014 and 15, we consolidated. 2016, 17, we had great years. 2018, we consolidated. What happens in 2019? I don't know. It's very difficult to tell. But just because we've gone up 331% and this bull market appears to be in the late cycles, doesn't mean that we can't make a lot more money in equities. So we don't want to abandon equities just because we've had success there. We want to be prudent, and we want to rebalance, and we want to take gains, but we don't want to totally abandon anything. So S&P annual earnings for 2019, analysts as of last week, analysts' earnings expectations are $178 per share. Okay, $178 per share, based on, and I had to change this a couple times based on what the market was doing, but $178 per share. The S&P closed at 2705 today. So you take, I forgot to update this here, but my math is done on 2705. So just pretend like this says 2705 here. 2705 divided by 178, you get 15.2. So earlier this year, people were willing to pay 19 times the S&P earnings. In 2009, the graph that I showed you at the beginning of 2009, end of 2008, people were willing to pay 12 point something times. So 15.2 is we're no longer overvalued. 15.2 is an attractive place for the domestic markets. If we look outside the domestic markets, we're even more attractive. So these levels, what's happened over the past 10 months is that earnings have improved, especially in the United States, driven by deregulation and the tax reform. And stocks have not moved anywhere. And so what happened is you get a lower PE multiple. Well, that makes the stock market more attractive at these levels, because you're buying a higher earnings stream for the same price that we could have bought it basically last year for, and therefore you get at 15.2 times. So we're very optimistic, really optimistic outside the United States. This makes us feel a lot better about the United States. We actually pared down some of our U.S. exposure for all of our portfolios back in late June, early July timeframe when we did our last rebalance. And one of the reasons is that we thought the U.S. was just getting a little bit overvalued. That no longer is as big of a concern to us. Now, like I said, interest rates play into this. As interest rates increase, we would tend to think that multiples are going to contract. But even if the 10-year Treasury was at 4%, a 15 multiple is well within reason if the 10-year Treasury is at 4%, which it's not. It's at 3.13% right now. So we think that this is a very attractive level to get in at. Like I said, in September, at the end of September, the PE multiple was 16.8. So even 25 days ago, we were at 16.8. We're now at 15.2. So all of these metrics are much lower. 15.2 puts us below the 25-year average. And if we were to update all of these valuation metrics, they're going to go from basically a little overvalued to probably a little undervalued when we're looking at the U.S. So it's not always about price. It's more about valuations. What are the earnings that we're buying? And right now, earnings are in the United States are phenomenal. So in 2017, earnings grew 17%. That's a really high number. Thus far in Q1, quarter or year over year, from Q1 2017 to Q1 2018, we grew 27%. Q2, 27% again. Q3 is right on track for right around there, 27%. Notice that a big chunk of this is what's called margin. What this is referring to is profit margin. So profit margins improving is representing 14.7% of the gain. Profit margins are at historic highs right now. We don't think they're going to be able to stay at historic highs. We think there's going to be price pressure on jobs, and that companies are going to become more competitive, i.e. you have Amazon raising the minimum wage to $15. That's going to put price or cost pressure on some of these companies. And instead of having record profit margins, the profit margin is going to come down a little bit. So what's more important, in our opinion, to watch is the revenue growth. If we can get 11%, 10.7% revenue growth and continue to see that in 2019, well, if profit margins come down a little bit, we're at a 15.2 multiple. If revenues go up, if the dollar, let's say, depreciates a little bit and we get a little bit of negative impact because of the dollar, we could still see stocks grow 8 to 10% in 2019. Not an issue from where we're at these levels. Why do I always pay attention to valuation? Why are PE multiples so important? Well, they're not important in the short run. And you can see that by this chart on the left. If we look at PE multiples and then say, okay, if I take that PE multiple what is my subsequent 1-year return from the S&P 500? Well, I get a scatter plot that's all over the place. It doesn't really matter. So by me telling you guys that the current PE multiple is 15.2, over the next 12 months, it doesn't tell us much. But over the next 5 years, it tells us a lot. This is the graph when we look at 5-year annualized returns. And if this is a much better regression than this one over here. So at 16.8, you move over here and you say, okay, well, we really should get whatever this return is. Let's call it 8%. If we're at 15.2, we're going to move left. We're going to move higher on this. So it means that over the next 5 years, if this plays out, we would expect a higher return, all else equal, with a lower PE, because you're buying at a more attractive price versus the earnings that the companies are giving you. That's why I talk about PE so much, because long run stock markets, they trade based on earnings. This just shows how tight the labor market's getting, and you can see the growth rate here in wages, and that's why we're expecting those profit margins to decline a little bit. You're going to see some cost pressure, and it's just, flat out, no matter how you look at it, the employment situation is tight. It's just it's a good situation right now. There are a lot of jobs that are open. We don't have enough skilled workers to fill all the jobs that are open right now. So companies are going to have to fight, and they're going to have to fight on price. Cyclical sectors, they've been choppy. Auto sales been choppy, but it's still above its 20-year average. We have housing starts that are grinding higher, getting back up to their 20-year average. Real capital goods orders look positive compared to where they were a few years ago. Inventories, they're trending down, which is good. We did see a little bit of a pop down in the second quarter and then a pop back up in the third quarter, so kind of wiped that out. Some of that has to do with tariffs and companies purchasing stuff prior to the tariffs going into effect, so that could have some headwinds to GDP growth in future quarters, in the fourth quarter and maybe early next year. You kind of moved some growth from 2019 to 2018 by having some of those tariffs and folks trying to beat the clock there. Consumer finances, I'm not going to hit on this too much. The consumers are really strong. Housing is still affordable, although as interest rates climb higher, housing becomes a little less affordable. But it's a great job market. Earnings up 2.8%. Gasoline prices are fairly low. Balance sheets look awesome. We've got almost $8 in assets to every dollar in liability. So the U.S. consumer is strong, and that's 70% of the economy. Federal finances, on the other hand, don't look as good. We have fiscal stimulus with the tax package, but was it really the best time to be doing that? You can see that the budget deficit is going to, based on the CBO forecast, is going to increase here in the next couple of years. And then the federal net debt is going to also increase pretty significantly. Two of the biggest budget items are still Social Security and Medicare and Medicaid. And so what I gather from this is that we're either going to have to pay higher taxes, or there are going to have to be some benefits reduced for Social Security and Medicare benefits being reduced. So as you're looking at your own financial plans, I would assume both of these types of things, or a combination of the two. Higher taxes, reduced reduced benefits. That could come in the way of means testing or increased IRMAs. A lot of you on the call know about IRMAs. They're additional premium that high income earners have to pay for Medicare benefits. It could be when you make a certain amount of money, maybe your Social Security gets cut. It could be that Social Security taxes go up on the folks who are working. So all of these things, we need to make sure that we've got a little bit of an idea of how that's going to impact our plan if these things happen, and what are things that we can do now to maybe control some of that. Economic growth, like I said, looks pretty good. We've already talked about GDP growth. Okay, so now we're going to get into international. And like I said, it really was a tale of 2 years. 2017 was great for international. 2018 has been pretty lousy for international. Tariffs have been a big noise that's out there that's having an impact. The U.S. only exports about 8% of our GDP, whereas some of these other countries export a lot more. And what the administration is doing is they would like for the ultimate end game to be less trade restrictions when we're all said and done. And to get there, they believe that the best way to get there is to take the leverage that we have and use it to make some of these countries cry uncle, basically. And the trade balances is something that they've focused on. And so let's just take China, for instance. We've got, 500 billion of China exports versus about 100 billion of U.S. exports. So we have a total trade deficit with China of about 400 billion. And so the administration sees that and says, okay, if we tariff and they tariff, we're going to be tariffing on all of this blue. They're going to be tariffing on the purple. We have leverage there. So this is how we can make them feel pain. And that is the strategy of the administration. We still believe that the end goal is that we end up with lower tariffs, all else being equal, than we currently have with some of these countries. How we get there might be choppy, might be not the prettiest thing to watch, but that's our most likely scenario out of all of this, is that we get some new trade deals that are a little bit more free trade oriented. Now, the way we get there is not free trade oriented. We're adding tariffs and taxes, which a tariff is basically tax, and that has an impact on inflation. And so we're starting to see some of that stuff come in, and the market's pricing in. Okay, right now we're talking about a tiny amount of tariffs, but if it comes and it's tit for tat, it can escalate pretty quickly. And so there's the market has priced in some of that probability that, hey, this trade skirmish becomes a full-out trade war at some point. So if we get some trade deals and some clarity there, we think that there's possibly some upside when those things become more transparent, when those become more clear. European recovery is coming along very well. Unemployment 8.1%, lowest in 10 years. Europe looks pretty dang good. Emerging markets, on the other hand, they've slowed a little bit. A lot of, some of that has to do with China. But when we're looking at the next 10 years, One of the things that we find very attractive about emerging markets is, one, their valuations right now are very attractive. Two, between India and China, we're going to have over 1 billion people go from poverty to middle class. That's something that we want to participate in. And the way we can participate is we can own some of the companies that are in those countries that are going to benefit from a whole mess of people going from basically having no disposable income to having a little bit of disposable income. But you can see by 2030, 79% of India's population is going to be in the middle class versus right now, or last year, it was 12%. That's a lot of people. And then China, 72% of the population will be in the middle class. Currently, there's 30. So that is one of the reasons that long run, we're very bullish on emerging markets. The other is that the valuations just look very attractive. Okay, not to beat a dead horse here, but domestic has outperformed international for the last 11 years by 125%. That's not always the case. In fact, over history, we just look at the last 40 years or so, 50 years, we see that it cycles from international doing better than domestic, domestic doing better than international, and so on and so forth. We never know which period we're going to be in. We never know if it's going to be a 1.4 year period or if it's going to be a 6.1 year period with 375% of outperformance. We don't know if it's going to be an 11 year period of 125%. So what we do know is we know valuations, and we know there's a lot of noise out there, and we can look out 10 years from now and say, okay, international emerging markets probably over the next 10 years are going to have some really good years in comparison to domestic markets. And so this just kind of shows us that it goes in cycles. And just to point out one of these cycles where if you're a U.S. investor, there's a lot of folks who are looking at their portfolio returns as of late, and because it's been so binary where if you've owned U.S. stuff, you've done well. If you've owned a diversified portfolio, you're kind of flat. Now with October, you're negative either way, but with October, you're more negative with a diversified portfolio than owning just domestic stuff. But that's not always the case. So once again, I went into the archives and I pulled out a 10-year period from 2000 to 2009, where if you were invested 100% in the S&P 500 over this period of time, you would have lost cumulatively. Let's say you would have invested $100,000 in 2000, the beginning of the year. At the end of 2009, that 100,000 would now be worth 91,000. You'd have lost 9% cumulatively over a 10-year period. So not a great period for the S&P 500. If we were to look at this asset allocation portfolio, which is 25% S&P, 10% small cap, 15% international, 5% emerging markets, 30% Barclays bonds, 5% market neutral, 5% commodities, and 5% REIT. So basically a diversified portfolio that owns every single one of these asset classes. Over that same period of time, your 100,000 that turned into 91,000, if you're fully invested in the S&P 500, your 100,000 is now worth 161,000 if you're in this asset allocation portfolio. So the problem is each and every year we have no idea which is going to be at the top, which is going to be at the bottom. But if we look at the past, we can see that this asset allocation portfolio, a diversified portfolio, i.e., stays, it's never the best, it's never the worst. It's right in the middle, and you get a pretty good risk versus return dynamic. And that's why it's important to have a diversified portfolio, because we don't want to just go all in on the S&P and then 10 years later we have less money than we started. That could happen with any of these indexes. Just like we could get lucky and over the last 6-7 years, the S&P 500 would have returned, over the last 10 years, the S&P would have returned 330% price, and you would have done really well. But the problem is we don't know that until we're looking backwards. And so the most consistent way and the best way to plan is from a diversified portfolio perspective. This just shows that 331% versus international markets only up 115% over that same period of time. Forward PE 12.9, that's as of September 30th, so it's a lot lower than that now. 16.8, it's a lot lower than that now. But we can just kind of see, okay, 20-year average of international, the PEs are 14.3. Before October, the current PE of international is 12.9, so significantly below, not 90% below the 20-year average there. And then if we look at dividends, we're currently at 3%, we're currently at 3.4%, and the 20-year average is 3%. So we're getting a lot bigger dividend than we normally do. So it's 149%. It's 149% of the 20-year average. So you're getting a lot better dividend yield than we would have in history. So these are just valuation metrics. So all that's saying is that international is attractive in comparison to its history. Domestic is not as attractive. Now, these numbers are all different right now. What's basically happened over the month of October is just everything's become more attractive than it was before. So if we had a really attractive spot, now it's even more attractive. Central banks and interest rates. Spend a little bit of time here. End of September, the 10-year Treasury was at 305. Early in October, there were 2 days it spiked to 325. And it was really quick. And that's pretty much what started this downtrend in equities. Since then, the 10-year Treasury has actually come down from 325 to 313, but it's still in an upward trajectory. We've got two things at play here. We've got the Fed increasing rates, and we also have the Fed reducing the size of its balance sheet. Where do we think the 10-year Treasury can be at the end of 2019? We think that at the end of 2019, the 10-year Treasury could be somewhere around 3.75% to anywhere over a little over 4%. That's kind of what we're targeting. That's why our bond portfolio is very short duration, because we do believe that bond rates are going to continue to go up. A big reason for that is that the balance sheet is no longer increasing. It is now decreasing. In fact, as of October 1st, the central bank has increased the amount that they're going to decrease the balance sheet by $50 billion per month. So they were doing $40 billion, they increased that to $50 billion. And so if we look at 2019, that tells us that every year they're going to be starting with 2019, they're going to be getting rid of $600 billion of assets on the balance sheet. In addition to that, they're going to be increasing interest rates. So the Fed is just one of the monetary authorities. We've got plenty of them around the globe. If we look at global Fed, global central bank balance sheets, we can see the Fed has already begun to shrink the balance sheet, but there's still other central banks that are increasing, and the orange line is kind of the net. And in 2019, we're going to start on a global basis. We're going to start to decrease balance sheets on a global basis, somewhere in the middle of 2019. There have been no rate hikes. There have been no rate cuts since 2016. So we've had 2 full years now of no cuts. The Chinese did just reduce some of their discount rates, but for the most part, major central banks are no longer super easy. We are transitioning to a more normal global monetary policy. What that's going to do is that's going to make global yields increase along with domestic yields. The yield curve has significantly flattened over the last couple of years. One thing that we definitely are watching is if that yield curve inverts, where the 2-year is higher than the 10-year, that would be a trigger for us. But one thing that we're just showing here is that interest rates in general have increased. This is a good thing for folks who own assets. Most of our clients, all of our clients. Household interest, what we pay in interest is $350 billion is what we pay, is what U.S. consumers pay in interest expense. What we earn in our interest-bearing accounts is $1.4 trillion. And so if we have that bigger number start to earn a higher interest rate, it doesn't matter that the smaller number is also being charged a higher interest rate. It's the bigger number that will prevail, and that's better for folks who own assets. That's better for retirees that have half of their portfolio in income-generating assets. So as interest rates go up, the future returns will likely be better going forward. Now, while the 10-year Treasury is increasing, as long as we're below 5%, it is usually a positive thing for stocks. Meaning, if interest rates are at 3.05% or 3.25%, and they go up by 50 basis points to 3.75%, because the interest rate level is still under 5, it's positive. Interest rates are positively correlated with stocks when the 10-year Treasury is below 5%. After we go above 5%, then as interest rates increase, stock prices decrease. So we still have plenty of room to have interest rates go up and still have stocks be able to benefit. Here's the inversion that we're taking a look at. Right now, the 10 minus 2 is at 0.3%. The last couple times the yield curve is inverted, it's predicted a recession. It doesn't always predict a recession, but we definitely would be monitoring the yield curve, and if it inverts, that would change some of our perspective on some of these things. Fed funds. There's a lot of talk that the Fed is wanting to normalize rates. A lot of people think that they're raising rates quickly. But if we actually look at the last 5 rate hike cycles, the average yearly increase in the Fed funds rate was 2.5%. So the slope over here is more indicative of the last 5 increases. We went from 1% to over 5% in 2 years. That's 2.5%. Since we started rate hiking in 2015, we've not gone very far. We've been doing about 1% per year. And that's basically what we're calling for in 2019, maybe 1.5%. But to say that the Fed is increasing interest rates quickly just does not jive with what's happened in the past. Interest rates and how they impact bonds. As interest rates increase, depending on what kind of bond you have, your bond will usually, if it's a treasury, the longer duration, so 5-year, 10-year, 30-year, as interest rates increase, the longer duration your bond, the more principal you're going to lose in that bond or that bond type of fund. And we can see that just by looking at the returns in 2018 through September. We've had about, call it about 25 basis points of increase in interest rates through September. You had the 5-year down 1.35, you had the 10-year down almost 4, and you had the 30-year down almost 7. But some bonds, the 2-year, it was positive. It had a little bit of price depreciation, but then it also earned some income. So it barely is positive. A lot of our bonds are this type of low duration. We have floating rate. We have high yield in our portfolio. These things have done well because they're not necessarily as interest rate. They have less interest rate risk. So you really want to make sure that you know what your bond portfolio is made of, especially if you think interest rates are going to continue to increase. I put this slide in here just to show that pretty much if you look at U.S. dollar returns in 2018, the U.S. the U.S. aggregate down 1.6. The global aggregate minus the U.S. down 3%. Now all of these numbers are a little bit worse because bonds actually have lost value, a little bit of value in October. But you can see basically every single bond is negative for this year, for 2018. That makes sense because interest rates have increased. However, looking forward, as interest rates increase, this chart right here shows the starting yield and the subsequent 5-year returns. It's kind of like that PE multiple chart that I showed with the stocks. Why is starting yield so important? Well, because it's directly related. The higher your starting yield, the better your next 5 years return. So as interest rates increase, the better our 5-year return projections are going to be for bonds. For the most part, there's a couple of periods in the 70s where we had a little bit of things going on where it was a little different, but for the most part, you see a pretty good trend here. The higher your starting yield, the better your 5-year return from those bonds. So increases in interest rates are ultimately a good thing for folks who own assets. Getting there might be a little bit painful, but remember, a bad day in stocks is a bad year in bonds. So bonds aren't going to kill you, even if they have a really bad year. You're still going to earn the income, and they're just not as volatile as stocks. So how to navigate? Stick to prudent strategies. So these are things that I have in pretty much every webinar, just to reiterate that we don't want, if the president tweets something or if we put tariffs on Chinese goods. We don't want to just jump to conclusions and change our entire portfolio strategy because of some noise that's out there. We want to look at the fundamentals, and we want to make sure that we have a good, prudent portfolio that's going to hit all of our goals and objectives, our investment goals and objectives. So first of all, cash. Cash right now is not paying a ton. It's paying a little bit more than it used to at about, you can find some money markets that are paying 1.5%, 2%, but inflation's higher than that. So you're still, if you park money in cash, you're still losing to inflation. There's a ton of money in cash right now, still. And that money is losing to inflation. At some point, those investors are going to want to get a better return, want to stay up with inflation, and they're going to rearrange some of that cash. So we've got a ton. We've got more cash currently than the entire consumer spending, than the entire mortgage debt that is outstanding. So that's historically, that's a very high amount of cash. Earnings yield versus bond yield. This just shows that stocks are still relatively more attractive than bonds. However, you can see that this thing is starting to get a little bit tighter now with what's happened in October. It's widened back out a little bit, but definitely still favoring stocks here at these levels. But it's not becoming, it's not like it was when we had this huge gap or some of these gaps. It's becoming a little bit closer. Earnings projections have not fallen off of a cliff, and in fact, earnings are, today was one of the heaviest days for earnings calls. And right now, earnings still look very good at 27%-ish quarter year over year for the third quarter, on top of 27% in the first and second quarters. So you can see analyst expectations are very high for earnings. Now, one thing we do want to keep in mind is that profit margins, like we talked about before, they're at all-time highs. And we just want to make sure that we're not, there's only so far those can go. We would probably assume that they're going to actually fall off a bit as cost pressure starts to increase with material cost and with labor cost. So we don't think that companies can keep earning profit margins at these levels. So that will have an impact on earnings. But even with that said, we've got 10+% revenue growth. So we definitely see corporate profits, and corporate profits are what drive stock prices long run. International, we've talked about international a lot. As of September 30th, emerging markets, very attractive compared to long run average. Europe, very attractive. Developed markets as a whole, very attractive. And then the S&P was a little overvalued at 16.9. It's now at 15.2, so it's below that. But all of these levels are also a lot lower. When we look at earnings, they haven't fallen off of a cliff. Maybe they slowed a little bit, but that doesn't give us concern for these type of valuations. U.S. investors have a hometown bias. It's normal. It's what you know. Just to put this into perspective a little bit, we can look at within the United States, and we can look at different regions of the country. We can look at back east and look at, there's a lot of financial companies back east, and what do they have? What are their portfolios overweight in? What they know, the financials. The West Coast, what do a lot of the West Coast, Silicon Valley know well? They know technology, and so therefore they have a 10% overweight in technology. The South, energy, 14% overweight. So you get the picture here. It's just showing that there are biases. Investors have biases to what they know. U.S. investors know the U.S. So, but that's not always the best way to allocate a portfolio, because if you look at where profits are, which drive stock prices, and you look at things like emerging markets and a billion people going from poverty to the middle class, you start to look at, okay, maybe I should be putting some assets to work outside the United States. The United States only makes up 24% of global GDP. 76% of global GDP comes outside the United States. So we definitely want some international exposure, emerging markets exposure. I know it hasn't done great the last 5 or so years, but at some point it will have its day, and you will be glad that you have it in your portfolio. Commodities, always a good thing to have in the portfolio at a reasonable level. Once again, if we look at commodities prices versus where they've been in recent history, we see a lot of these at lower level. We just look at the Bloomberg Commodity Index. We're on the low range. Agriculture, a lot of that has to do with these tariffs and soybeans. We've got some of these, gold and crude oil, starting to get back to their long-term averages, but as a whole, commodities still look pretty attractive at these levels. And if we do start to see some inflation, one of the best pieces in your portfolio to battle inflation is this commodities segment. Limiting losses, and just, we looked at a period of time from 98 to September 30th of this year, and said, okay, if we had an all stock portfolio, all S&P portfolio, where would we be versus a 60-40, and then kind of look at levels. And it just shows the importance of limiting losses. You don't take as much of a roller coaster ride with the 60-40. Now, at the end of the day, you made less money, and if you're accumulating money for retirement, you probably are okay taking a lot of risk as long as you can handle some of these downturns. But if you're starting to take money from your portfolio, these downturns, if you're in too aggressive of a portfolio and the downturn ends up to be too much, and you're taking a distribution that may have started at 4%, but because the portfolio goes down from 100,000 to 70,000 in a couple of years, your 4% withdrawal now is 7%. That's going to have a big impact on how long your money lasts, and therefore that's why the bonds are, even though they're less attractive to us over the long run. Not everybody has the same time horizon, and bonds are definitely an income-oriented strategy that should be part of a portfolio where we're taking money from the portfolio, basically in almost every single case, unless the portfolio is just way, you're taking 0.5% from the portfolio and you can afford to put it in stock and just earn 2% in dividends and call it a day. But if most people don't have portfolios that are that large compared to what they need to live off of, and so therefore we need some safety in the bond in the portfolio, and that comes in the form of bonds. I'm going to skip this chart here. It's a little bit too much. I'm going to skip this chart as well. We're at a little over an hour here. This just shows what our returns have been, and I put this one in here because the last 2 years, basically, we've for 2 years, 2016, early in the year, we had a pullback of 11%, but then after that, the biggest pullback we had for almost 2 years was 3%. And then this year, we've had 2 that have been over 10%, that have been 10%. And the first one, not a lot of people realized because the market went up 8% and then down 10. And it happened so quickly, it happened within a month, that a lot of people, whatever, I didn't even get a statement that showed me that my accounts were up 8% at one point. So it's out of sight, out of mind. But this last 10% pullback, since it started at the beginning of the month, people are nervous. It seems to be having a larger impact on folks than the earlier 10% correction that we had. But all of it is normal. Our normal pullback during a year is 14%. We should be prepared every year that our portfolio is going to pull back, that the market's going to pull back, sometimes large numbers. So that should be our expectations going into a year, that we're going to see some volatility, we're going to see some noise, and we can blame it on China, we can blame it on interest rates, we can blame it on elections, but when it comes to it, the market is a bunch of human beings making financial decisions, and human beings have behaviors that are not always logical, and therefore we get some fluctuations. The good thing is that over a long period of time, you get paid a higher return for putting your money at the risk of these fluctuations. Now, contrast that with, this is the same chart for bonds, and you can see there's only been 2 years that bonds have been down more than 5%. So like I said earlier, a bad day in the stock market equates to a bad year in the bond market. So when I say I don't really like bonds, it doesn't mean that we're just going to abandon bonds. They're still a good piece in the portfolio. We just may not see as much of a return in those areas, but we're also not going to see a big downward move in those areas either. They're safety. They're an anchor for our portfolio. All right, now we can look at over the last, from 2003 to 2017, that asset allocation portfolio over this time has earned 8.3%, very close to the S&P 500. Emerging markets have been the best over that period of time at 12.7, but then this other column over here shows risk. And we were able to get 8.3% with this asset allocation portfolio with a very low risk compared to some of these other areas. And once again, if you're a golfer, we want to be right down the fairway. It's a much more predictable, still not predictable, but the returns are all over the place, 26%, minus 25%, 25%, but it's right in the middle. It's never the worst, never the best. It's right in the middle, and we end up with a decent return when we look 15 years down the road. That's where we want to be. We don't want to just pick one of these asset segments and hope for the best. That's not the most prudent portfolio strategy. And I know it's very easy to get tempted, especially in a period of time that we've seen over the last 5 to 10 years, at really getting enamored with the S&P 500. But we need to make sure that we don't get enamored, because the next 10 years could be completely different. So investment implication, what does this mean with the portfolio? We are overweight small caps. If you guys couldn't tell, I think international and emerging markets are attractive. So we're definitely overweight in those areas. We don't like fixed income, especially long duration. It's not that we don't like domestic equities, we just prefer international. So we'd rather have some of our stock exposure be international than domestic. But we still do have a big significant chunk in domestic. And then REITs and utilities, both sectors that have done well in October, as we've seen a flight to safety. But if interest rates continue to increase, these areas we don't think will do as well. So with that, I know we're running about 15 minutes late, but I'll open it up to questions. So Jared, you want to go ahead and take it over?
So at this time, we'll open the webinar to questions from the meeting attendees. You guys can type in your questions into the chat, and we'll give you a minute or two here if you have any questions. Otherwise, I have one for Scene. So as you mentioned in an earlier slide, many of the market corrections that have occurred in the bull market have been credit related. Given the everything that's surrounding credit with rising interest rates, the Fed balance sheet, Italy, do you see any immediate risks as far as sending us down the tumble of the credit cycle?
Not domestically, no. Companies have very strong balance sheets. Consumers have very strong balance sheets. Coverage ratios are all very strong. When it comes to international, there are some countries, like you mentioned, Italy, that are going to have to go through budget issues, and they're going to have to get it approved by the EU. So there's definitely some credit risk outside the United States, but we're also getting paid very, very well for some of that. I'd say I'm a little cautious when it comes to yield spreads. We're taking some of this credit risk, but we're not getting paid as much as we normally do. So there's some credit risk there, but right now in our portfolios, we are very short, and the credit risk is not all that great. And we have, other than emerging markets debt, we do not have very much international exposure on the fixed income side of things.
Well, it appears we have no other questions. Thank you for taking the time today. Scene, you did a wonderful job as usual.
Thank you, and thanks for everybody for joining. Next webinar will be the first Thursday of February. So enjoy the holiday season. Happy New Year, and we'll see everybody in the new year, 2019. Thank you. Good night.
Thank you, everybody.